GPIX wins the marathon, SPYI wins the sprint, and the smoother ride while it's running. Same S&P 500 exposure, two completely different winners, depending on what you're actually asking the model. I built the same breakeven-CAGR model I used on my NASDAQ 100 funds, and pointed it at these two. It's not a clean sweep this time. One fund needs less market growth to hold its price flat, and wins on total dollars over 10 years. The other one actually holds up better in a short correction. Both things are true at once, and by the end of this, you'll know exactly which one earns which title, and why neither one is simply the better fund. Both of these track the S&P 500, same 500 stocks underneath. GPIX sells call options on a dynamic slice of its holdings. Goldman's managers move that coverage between 25 and 75% depending on conditions, at a 0.29% expense ratio. SPYI runs a call spread overlay across the full position, selling a call, buying a higher one back with part of the premium, at a 0.68% expense ratio, more than double GPIX's cost. That fee gap alone is part of the story here. Before either fund's option strategy does anything at all, SPYI is already giving up almost 0.4% a year that GPIX isn't. This is the actual training question underneath this whole video. Marathon training builds an engine that holds up over years. Steady mileage, patient pace, a body that's still improving in month 18. Sprint training gets you explosive, immediate output, and when the terrain gets rough mid-race, a trained sprinter's shorter, more controlled bursts can actually absorb a bad step better than a marathoner grinding through fatigue at mile 20. Neither approach is wrong. They're built for different races. The mistake is expecting marathon durability from a sprint program, or expecting sprint day smoothness from a marathon engine that's built to pay off over years, not this week. That's exactly the split I found in the data. Here's the number. GPIX needs the S&P 500 to grow roughly 9.2% a year just to hold its price flat. SPYI needs roughly 15.2%. The S&P 500's own long-run average sits between 8 and 11%, depending on the look-back window, comfortably covering GPIX's line, sitting well below SPYI's, and this already happened. Since launch, GPIX's price has grown about 12.8% a year, above its own break-even. SPYI's has grown about 1.6% a year, well below its. Same pattern I found on the NASDAQ 100 pair, on a completely different index. One more thing before the dollars. GPIX's yearly capture of the index's total return has held tight, in the high 80s to low 90s, both years I have clean data for. SPYI's has swung from 69% to 94% year to year. GPIX's number is more predictable. That matters for how much weight you put on a model like this one going forward. Now, the dollars. Put $10,000 into each fund. Even in the conservative case, the weak market, 10 years out, GPIX's position is worth around $16,800. SPYI's has drifted down to around $14,700. SPYI pays more every single month in every scenario. That part of its pitch is real, and it doesn't go away. But add the position value back to every distribution collected, and here's what's different from my last model. GPIX leads on total dollars starting in year 1, not year 3. In the conservative case, 10 years out, about $16,800 with GPIX, about $14,700 with SPYI. GPIX wins the marathon clearly, and it doesn't take long to show. Here's the twist that makes this fund pair more interesting than my last one. I checked what happens during actual short corrections, not the 10-year race, the bad week in the middle of it. In every single down window in this data set, SPYI's total return held up better than GPIX's. Roughly 72 to 83% of the S&P 500's decline for SPYI versus 73 to 91% for GPIX. The marathon runner doesn't sprint as smoothly through a rough patch. The sprinter does. One more thing I want to flag honestly, because it came up in reporting from just this past week. SPYI's payout ratio is running well above its net investment income on standard screeners, and more than one outlet has pointed out that a sustained stretch of low market volatility this summer is a real risk to how long that distribution rate holds. That's outside reporting, not my own primary source finding, but it lines up with exactly the structural gap this model already found. So here's where that leaves it. GPIX wins the marathon, SPYI wins the sprint, and the smoother ride while the race is rough. Neither one wins cleanly, and I'd rather tell you that than force a winner where the data doesn't have one. GPIX is already in my 5-fund income floor on the S&P 500 side. This model is the first time I've actually tested whether it's earning that spot with real numbers instead of just a yield I liked at the time, and it is. TPay is technically the other S&P 500 leg of that floor, and I know some of you will notice it's not in this video. It's still too new and too small for this kind of modeling, and its actual mechanism doesn't fit an overwrite framework at all. That's a separate video once it's ready. SPYI isn't a fund I hold, but seeing exactly why it trades a smoother short-term ride for a weaker long-run break-even line is useful on its own, whether or not it's ever in your own portfolio. The marathon versus sprint question isn't really about these two funds. It's about knowing which race you're actually running before you pick the training program, in the gym or in an account you're not touching for 10 years. If this breakdown was useful, hit the like button. It helps more people find it. Subscribe if you want to see the same model run on the next pair in the floor. That's coming. And I want to know, marathon or sprint? Are you building for the 10-year number, or do you want the smoother ride along the way? Drop it in the comments.